welcome to this special edition of The Real Estate Seller. I'm Dawn, and I am actually here with Michael K. Miller, attorney extraordinaire, tax attorney extraordinaire, and he's going to help us because coming up April 15th, normally every year, April 15th, that's the day you have to file your taxes. This year, happens on a Saturday, so we get a little two-day breather. But we brought Michael on to talk taxes with us because our real estate agents are the ones who typically need to know a lot about taxes. So Michael, welcome. Welcome to the Real Estate Seller.
Thank you for having me.
All right, we're going to start off with the meats and bones of what's going on here. Real estate agents. I'm a real estate agent. I've worked all year. I never filed my estimated quarterlies because I didn't know if I was going to owe money at the end of the year, and now I'm stuck. Talk to me a little bit about why real estate agents and brokers need to file those estimated quarterlies.
Well, it's real estate agents have more tax problems than pretty much any other profession, and it's really due to the nature in which they're paid. Commission-based, independent contractors. But really, the problem I see with real estate agents is they have a hard time paying the quarterly estimated payments, which you're supposed to do. We have a pay-as-you-go system. So if you've been an employee before, you know that you don't have a choice. You take it right out of your paycheck. Mm-hmm. Well, with self-employed people, they're supposed to pay quarterly estimated payments. With real estate agents, the problem is many, when they're getting ready to make the payment, say April 15, they have a hard time cutting loose with the money because they may go 6 months without another commission. Mm-hmm. And they won't be able to get that money back until they file their tax return and get a refund. So there's kind of a tendency to want to hold on to that money and maybe wait till the next quarter is June 15th.
What do they do though? I mean, you're a real estate agent. You're not sure if you're going to owe $10,000. You don't know if you're going to owe 2, 5, 10. How do you figure it out?
It's a safe harbor because there are two ways to do it.
All right.
The law says you have to either pay in 100% of your tax liability from the prior year, mm-hmm. or 90% of the current year's tax liability. Well, obviously, you're not going to know how you're going to do this year if it's April. So usually people take the safe harbor. They've already done their tax return for the prior year. Mm-hmm. Let's say they owed $40,000 of tax. Mm-hmm. You know, they made 120 and their tax is 40 or something. You divide that number by 4, it's 10,000. You pay that every quarter. April 15, June 15, September 15, January 15 of the next year. Yeah. Now you've paid in 40 grand. Your tax was 40 grand last year. So probably if you have a similar year, you will have paid in all your taxes. You file your return, you get a small refund or pretty much break even, and that's how it's supposed to work. Mm-hmm. But many don't want to pay their estimates for the reasons I just gave, and they come up to the end of the year, or they don't want to give the government an interest-free loan, which I can understand. Mm-hmm. So they say, I'll just wait and pay it when I file my return next April 15. Yeah. And that's fine and dandy if you can put away the money. But most people don't have the money put away. So they get ready to file the return. They don't have it, so maybe they don't file at all, which generates penalties and so forth. And then many times you get in just a spiral, and the next thing you know, you haven't filed in 5 or 6 years, and you got levies and so forth. So that's, fairly common.
I'm gonna make a suggestion to our viewers, especially our real estate agents out there. Every closing that you have, don't think of every dollar that you get from that closing as yours, because it's not. Take the amount that you're going to owe or potentially owe from that one closing and open up a separate bank account and put the money in that separate bank account and forget it's there.
You could do it that way. You don't have to make quarterlies. In other words, you can make it's okay if you want to make a payment every time you have a closing. A rule of thumb would be to take 30% of your commission. Would probably cover your income taxes and your self-employment tax. Remember, a real estate agent has to pay self-employment tax that funds the Social Security system and Medicaid. It's 15.3%. And then you've got an income tax, which could be anywhere from 10 to 37%, something like that. So if you take a third or 30% or a third of your payment, either one of those should do it. You're probably paying in enough to cover. You might owe a little bit next April 15th, but that's fine. You'll be able to pay it. But so you could make it every time you have a commission. You should make it at least once a quarter. But There's a number of ways you can do it. You can do it every month.
But what if they just can't deal at all with the whole thing? Who can they call? Like, who's the professional that they could just say, you do it? Who's that person? Is that your CPA?
Probably
or
the CPA.
A bookkeeper?
Yeah, whoever does your tax returns could probably handle that. When
You don't do that though.
Well, I can, but I mean, when you get your tax return done, they'll give you 4 vouchers as part of the tax return for the prior year.
Your CPA does that?
Yes.
Okay.
And there's vouchers for each quarter. So it's what you're supposed to send in with your check when you make your quarterly payments.
Right.
Then it's just a matter of, having the money to
I do mine online.
and mailing it over. You can.
Yeah, I go into the little online account, and every
Right.
quarter I just upload
Perfect.
whatever we're supposed to do. So, all right, so now the next subject. Oh, by the way, wait, hold on. File your tax return. Tell us why, you told me before we started, but tell us why it is so important that you file your tax return every single year. Tell me that story.
Because of the penalties. So when you don't file your tax return, you incur 2 penalties. One is for failure to file, for not filing the return on time, timely, and the other is for failure to pay. But the interesting thing about it is the failure to file penalty is much greater than the failure to pay penalty. It's 10 times greater. It's 4.5%, and the failure to pay penalty is only 0.5% per
Wow,
month.
that's huge.
Multiplied by your balance. So by simply just filing the return, with nothing more than a tax return that says I owe $30,000, but I'm not including a check, just by putting it in mail with the cost of that stamp, you've eliminated 90% of the penalties that you're going to incur for that year.
That's huge.
Because now your only penalty is, because you filed on time,
Yeah.
your only penalty is the small 0.5% per month penalty for not paying.
Right, so max 6%
not
per year for not
And
paying.
then you've got interest is accruing at 3% right now.
Right, and 4.5% times 12 is a lot more.
Just by buying that stamp and making that, filing the return, you've eliminated most of the penalties, 90%. It's too easy.
Yeah.
And that penalty really, it doubles, it'll double your balance every 7 years.
What do you do if you can't pay it? What do you do? Is like, I got to file,
You
right?
call me and then I get you into a payment plan.
Oh, they do that?
Or if you have a number of years and you have a number of years liabilities, you may be able to get a one-time settlement with the IRS, get a clean slate, start over with no money owed, pay them a fraction of what you owe maybe, and that's called an offering compromise.
So
That's a settlement.
let's say I haven't filed for 10 years.
Yes.
Okay? And now all of a sudden it caught up with me. I filed, just so you know. But let's say someone other than me doesn't file for 10 years. Okay, so 10 years ago they didn't file last 10 years. Now, when the IRS catches up with you, can they go back 10 years because you didn't file?
Well,
What
they
can
would
they do?
generally only go back 6 years. It's in the Internal
Okay.
Revenue Manual. It says something like, except in unusual circumstances, they will only go back for 6 years. So if I call them for a client today who hasn't filed in 10 or 15 years, they're going to only want me to file 16 through 21.
Okay.
And so I would get the wage and income transcripts that would show me what W-2s or 1099s the taxpayer had those years, and I'd use that to be able to prepare the returns, and we would file the returns, and then they would get a bill with interest and penalties tacked on, and then I have to go to work to try to resolve it. And that's going to be either a payment plan or possibly that offering compromise I just mentioned, where you offer them a bone to go away, and sometimes they do go away, and you've got a clean slate.
Okay.
So that's where you get the most bang for your buck. But some kind of resolution. Otherwise, if you don't file, many times the IRS will file for you. It's called an SFR, substitute for return. Generally, they'll wait about 4 or 5 years, and if they've sent you letter after letter saying we haven't gotten your 2017 return, and you completely ignore them, they will eventually do a return for you. How do they do that? Well, they have the 1099s and W-2s. They've been sent by the payors. So they use that.
Oh, right, yeah.
They have the income, but what they don't know is they
The
don't know.
expenses.
Well, they don't know if you have real estate taxes to deduct, mortgage interest. So the tax on the return they do is always overstated. So it's not a good thing to
Oh,
do.
do they tax it on the gross? So
Well, they tax it on the gross. And
File,
they give
you
you
get
the
your
worst filing
write-offs.
status. If you're married, they don't give you married filing
They give you
jointly.
0.
They give you single, which makes you pay more tax. And so you can file your own return and they'll throw theirs out and accept yours. But initially they will do the return for you. They'll put the assessment on the books. They'll file a tax lien against you. Even though their tax is not really what you owe, you probably owe a lot less. They'll put the tax lien out there and tell the world you owe this significant amount of money. And And then if you don't cooperate and get some kind of resolution, like a payment plan or do an offering compromise or something, or pay it off, they will levy your assets.
Okay.
So that's why not filing, there's a number of reasons why you shouldn't do it. One is the penalty for failure to file. The other is, they're going to file for you and eventually assess it anyway. The tax is going to be much greater than if you do it yourself. So really not filing is not a good solution.
Not filing, really bad idea.
If you don't have the money, at least file and stop that penalty, and then we can do something about the payment. I can get you into a payment.
That is such good advice. I have never once before heard to do that, to just say, because people are like, well, I don't have the money, so I'm not going to file. No, file anyway, and then call Michael.
It's not going to go away because the IRS usually already knows what you made, because whoever you work for, whether you're self-employed or W-2, they've already sent a W-2 or 1099 to the IRS. They already know it. You're not going to hide from it. If you're completely under the radar and you're getting cash, maybe you could avoid it, but it's still not a good idea.
No.
But if you're at a normal job where you're getting a 1099 or W-2, the IRS knows what you're making because they get a copy of that. So it's not a good, not a good practice at all.
Okay, I agree with you.